You might be looking at the financial news today, seeing the stock market turning a deep, angry red and thinking, this is just another day of standard volatility or perhaps a temporary political spat. You see the headlines about Donald Trump watching Wall Street tremble, and you hear the pundits talking endlessly about borders and tariffs. But I want to stop you right there, because if you are only looking at the physical borders and if you are only listening to the noise about trade goods and tariffs, you are missing the much bigger, much more dangerous story that is unfolding right beneath your feet. What we are witnessing right now is not just a market correction, and it is certainly not business as usual. It is a fundamental exposure of the fragility within the American financial system, triggered by a maneuver that very few people saw coming. While everyone was distracted by the political theater in Washington, Mark Carney and the Canadian financial establishment have aimed what can only be described as a financial bazooka at the very plumbing of the United States economy. I'm talking about the kind of systemic shock that does not just lower stock prices, but threatens to freeze the credit lines that you, your local businesses, and your communities depend on to survive. I want you to really understand that what is happening here is a brutal lesson in how modern global capitalism actually works, distinct from the fairy tales we are often told about independent national economies. The story being sold to you on the cable networks is likely one of political strong-arming, a battle of personalities between leaders. But I am here to tell you that the real story is about capital, who owns it, where it lives, and what happens when the owners decide to take it home. We are looking at credible reports that Canadian banking giants, massive institutions like TD Bank and RBC, are under pressure to restrict lending and repatriate capital back to Canada. Now, you might think of these as foreign banks that stay in their own lane, operating politely north of the border, but the reality is that these institutions hold hundreds of billions of dollars in American assets. They are deeply embedded in the U.S. financial grid, and when they sneeze, Wall Street catches a cold. And right now, let's be clear, they are not just sneezing, they are effectively threatening to walk out of the room with the oxygen tank. Let us dig into what is officially happening here so we can clear away the fog of war and get to the hard facts. The core event driving this panic is a strategic withdrawal of liquidity. Mark Carney, a man who knows the inner workings of central banks better than almost anyone alive, understands that money is the blood of the economic body. By signaling a potential repatriation of funds, meaning bringing that money back to Canada, he is creating a sudden vacuum in the U.S. banking sector. This is what economists call a liquidity crunch, but those are just polite words for a financial heart attack. To put it in plain terms for you, imagine the U.S. economy as a massive engine that requires a constant flow of oil to keep the gears turning. That oil is credit. It is the daily loans, the overnight lending between banks, the lines of credit for small businesses. Canadian banks have been supplying a significant portion of that oil, and if they suddenly turn off the tap, the engine seizes up. It does not matter how big or powerful the engine is. Without the lubricant of liquidity, it grinds to a halt. This is the nuclear option of economic warfare because it bypasses the slow-moving trade disputes and strikes directly at the ability of U.S. banks to function on a daily basis. I want to take a moment to define exactly what we mean when we talk about this financial plumbing, because this is where the system usually hides its secrets from the average working person. When we talk about liquidity, we are not just talking about cash sitting in a vault somewhere. We are talking about the ability of banks to meet their immediate obligations. Regional U.S. banks, the ones that are not the massive too-big-to-fail giants on Wall Street, but the ones that might hold the mortgage on your house or the loan for the bakery down the street, operate on razor-thin margins of liquidity. They rely on the interbank market to balance their books every single day. If major players like the Canadian banks stop participating, or if they pull their deposits and assets out, those regional banks are suddenly left holding the bag. They cannot find the cash they need to operate, and this is exactly how you get a bank failure. It is not necessarily because the bank made bad loans, though many have. It is because the money they count on to flow through the system has suddenly stopped flowing. You need to realize that this situation was not created overnight. It is the result of decades of financial integration where capital was allowed to move freely across borders in search of the highest return. with very little regard for the stability of the communities that rely on that capital. We were told that this global integration was efficient, that it would bring prosperity to everyone, but what it actually created was a system of deep interdependence where a decision made in Ottawa or London or New York can shatter the economic security of a family in Ohio or Pennsylvania. The vulnerability of the U.S. banking system to Canadian capital is a feature, not a bug, of this globalized financial capitalism. The U.S. encouraged this investment. It welcomed these banks because they brought cheap credit and fueled the debt-driven expansion of the American economy. Now the bill is coming due, and the vulnerability is being exploited. Think about what this means for you personally. You might not have a bank account with TD, or you might bank with a local institution that has been in your town for 50 years. But that local institution exists within a web of credit, and if the big Canadian players pull back, the cost of borrowing money goes up for everyone. Your local bank has to pay more to get the cash it needs, and it passes that cost on to you, or worse, it simply stops lending entirely. We are already seeing reports of small businesses across the East Coast finding their credit lines frozen. That is not just a statistic. That is a shop owner who cannot buy inventory for next month. That is a contractor who cannot pay their crew until the client's check clears. That is the real-world impact of this high-level financial poker game. When liquidity dries up, it is the working class and the small business owners who feel the thirst first, long before the executives on Wall Street miss a bonus. We have to look at the background of how we got here to truly understand the gravity of this moment. This is not just about a single political disagreement between the current administration and Canada. This is about the structural power of finance capital. For years, the U.S. economy has operated on a deficit, importing capital from the rest of the world to finance its consumption and its military spending. We have been living on borrowed time and borrowed money. Countries like Canada, with their stable banking sectors and massive pension funds, have been the ones lending that money. They bought U.S. treasuries, they invested in U.S. corporate debt, and they expanded their retail banking operations into the U.S. market. This created a situation where the debtor, the United States, is at the mercy of the creditor, even if the debtor likes to pretend they are the one in charge. Donald Trump knows that a banking crisis is the one thing that can destroy a presidency instantly because it reveals this underlying weakness. It strips away the illusion of total control that is so essential to his political brand. He can rally against political opponents, he can dismiss media criticism, but he cannot tweet his way out of a liquidity trap. This brings us to the specific mechanics of what Mark Carney is doing. And it is a stark reminder that in capitalism, political power and economic power are often fused in ways that are invisible until the moment of crisis. Carney is not just a private citizen offering an opinion. He represents a nexus of state and financial power. By leveraging the Canadian banks, he is using the tools of the free market to achieve a distinct political end. He is proving that Canada does not just trade physical goods like lumber or oil. It owns a massive chunk of the American ledger. And the rule of finance is simple. If you own the ledger, you own the leverage. This liquidity crunch is a brutal demonstration of that leverage in action. It creates panic not because of what has already happened, but because of the terrifying uncertainty of what happens next. Markets hate uncertainty more than they hate bad news. If regional banks start to wobble, depositors get scared. If depositors get scared, they withdraw their money. If they withdraw their money, the banks collapse. It is a self-fulfilling prophecy, a chain reaction that starts with a quiet decision in a boardroom and ends with a closed sign on a storefront in your neighborhood. I want you to really sit with this idea because it is uncomfortable. The stability of your economic life is being used as a bargaining chip in a geopolitical struggle. This is the nature of the system we live in. It is not a system designed to ensure that you have a job or that your savings are safe. It is a system designed to maximize the power and profit of those who hold the capital. And right now, the capital is moving. The tectonic plates of the financial world are shifting, and we are the ones standing on the fault line. As we go deeper into this, we are going to look at exactly who is responsible for leaving us so exposed and why the so-called experts let the system become this fragile in the first place. Because, make no mistake, this was allowed to happen. The regulators, the politicians, and the bank CEOs built this house of cards, and now they are acting surprised that a strong wind is threatening to blow it down. Let us walk through the mechanics of this because I want you to see exactly how the gears grind to a halt. When we say Mark Carney is pulling capital, do not imagine someone walking into a vault in New York, stuffing cash into a suitcase, and flying it to Toronto. That is the movie version. The reality is far more digital, far faster, and far more devastating. The modern banking system runs on what we call overnight lending and short-term credit markets. It is a daily, furious exchange of billions of dollars just to keep the lights on. Every single night, banks lend money to each other to meet regulatory requirements. Canadian banks, because they are massive and stable, are often the ones doing the lending. They are the creditors. The regional American banks are often the ones doing the borrowing. So here is how the weapon works. The directive comes down quietly, perhaps not even written on paper, but understood in the boardrooms of Toronto to simply stop rolling over the debt. That loan that a regional bank in Pennsylvania relies on to balance its books every night, suddenly the Canadian bank says, no, we are not renewing that today. We'll take the cash back. Thank you. It sounds polite, but in financial terms, it is a violent act. It forces that regional bank to scramble. They have to find that money somewhere else immediately. But if TD and RBC, who collectively control a staggering amount of the U.S. market, all step back at once, there is nowhere else to go. The price of borrowing that overnight cash spikes. The regional bank is now bleeding money just to stay solvent. This is the liquidity crunch. It is like removing the bottom row of a Jenga tower while the game is still going. Now connect this to the repo market. I know that sounds like jargon, but think of it as the pawn shop for the global financial system. Banks trade safe assets like U.S. Treasury bonds for immediate cash to operate. It is the grease that keeps the wheel turning. Canadian banks are huge players here. If they stop accepting those assets or if they demand higher interest rates to provide cash, the grease turns into sand. The gears lock up. And when the gears lock up on Wall Street, the conveyor belt stops on Main Street. This is where the story hits your life. That regional bank, now panicked and desperate for cash, does the only thing it can. It hoards money. It stops issuing new loans. It calls in existing lines of credit. Let's make this concrete. Imagine a construction company in the Midwest. They have a standard revolving line of credit they use to buy lumber and pay their workers before the client pays the final bill. They have been with their local bank for 20 years. They have never missed a payment. But tomorrow, the owner calls the bank to draw down on that credit line to start a new project. And the bank manager says, I'm sorry, we've frozen all new credit draws. Why? Not because the construction company is a bad business, not because the owner did anything wrong, but because a decision made by Mark Carney to squeeze the U.S. financial system has drained the local bank of the ability to lend. The construction company cannot start the job. The workers do not get the shift. The lumber yard does not get the order. The economic activity simply evaporates. That is the power of the financial bazooka. It destroys real wealth, real jobs, and real production without a single factory being bombed. And we must be honest about the actors involved here. Mark Carney is not just a politician. He is the ultimate insider. He was the governor of the Bank of Canada and the governor of the Bank of England. He is a man who spent his career building and managing this global financial architecture. He knows exactly where the pressure points are because he helped write the manual. He knows that the U.S. banking system, despite all its bravado, is highly leveraged. He knows that U.S. regional banks are currently sitting on portfolios of commercial real estate loans that are losing value every day. He understands that by tightening the screws on liquidity right now, he is pushing those fragile banks toward the edge of a cliff. It is a calculated surgical strike designed to maximize pain while maintaining plausible deniability. He can simply say Canadian banks are just being prudent. They are risk managing. But we know better. This is economic statecraft. This exposes the dangerous game that Donald Trump and the U.S. political class have been playing. They assumed that American economic power was absolute. They assumed they could use tariffs and borders as blunt instruments to get what they wanted, thinking the rest of the world would just have to take it. But they forgot, or perhaps they never understood, that in a financialized global economy, ownership is everything. You cannot bully your banker when your mortgage is up for renewal. And right now, Canada is acting like the banker. The U.S. economy, for all its strength, is a debtor economy. It consumes more than it produces. It borrows to fill the gap. When you alienate the people who are lending you the money, you are not negotiating from a position of strength. You are negotiating from a position of vulnerability. This leads us to the critical question of responsibility. Who let it get this far? How did we end up in a situation where foreign banks have this much leverage over the American heartland? The answer lies in the deregulation and financialization that both parties in Washington have cheered on for 40 years. They told us that capital needed to be free. They told us that letting global banks merge and acquire and cross borders without friction would make us all richer. They dismantled the barriers that used to protect local economies. They allowed the financial sector to become the master of the economy rather than its servant. Look at the history. When Canadian banks started aggressively expanding into the U.S. after the 2008 financial crisis, American regulators rolled out the red carpet. Why? Because American banks were broken and needed the capital. We sold off our financial sovereignty because it was the easy fix. We let TD Bank become one of the 10 largest banks in the United States. We let them take over massive chunks of the Midwest banking market. We invited them in because it kept the bubble inflating, it kept the credit cards swiping and the car loans flowing. No one asked what happens if our interests diverge, what happens if there is a conflict. Now we are finding out. The policymakers who are currently scrambling to contain this panic are the same ones who built the trap we are caught in. And do not think for a second that the corporate executives at these banks are innocent bystanders. They play the game of nations when it suits them. For years, they profited from the stability of the U.S. market. They extracted billions in fees and interest from American workers and businesses. Now they are weaponizing that position. It reveals a fundamental truth about these institutions. They have no loyalty to you, to your community, or to the American dream. Their only loyalty is to their balance sheet and their shareholders. If crushing the U.S. regional banking system protects their capital or serves their political masters, they will do it without hesitation. So, as you watch the panic on the news, as you hear reports of banks wobbling and credit freezing, remember that this is not a natural disaster. This is a man-made crisis. It is the result of a system that prioritized global financial integration over national economic security. It is the result of allowing the plumbing of our economy to be owned by entities that we do not control. And now the water is being shut off. In the next part of this discussion, we are going to look deeper into the specific key actors, the politicians and the CEOs, and how their arrogance blinded them to this possibility. We're going to examine why the regulators were asleep at the wheel and why the working class is always the collateral damage. When the titans of finance decide to go to war, the system is working exactly as it was designed, for them, not for you, and that is what we need to confront. Let us look closely at the men standing at the controls of this machine, because their actions and their inaction tell you everything you need to know about who really runs the economy. On one side, you have the political class represented here by Donald Trump and his advisors. They operate in the world of the visible. They give speeches about factories, they sign executive orders about tariffs, and they obsess over physical borders. They think power is something you can build with bricks and mortar or enforce with a signature. But on the other side, you have Mark Carney and the technocratic elite of the financial world. These people operate in the shadows, in the world of the invisible. They understand that real power in a capitalist system isn't about what you can see. It is about who controls the flow of credit. Carney is not acting out of emotion. He is not a politician shouting at a rally. He is a central banker to his core, a man who has sat at the head of the table at the Bank of England and the Bank of Canada. When he moves with the cold mathematical precision of the system itself. He represents the global financial order that feels threatened by the kind of economic nationalism Trump is trying to sell. By potentially coordinating this withdrawal of capital, Carney is sending a message that is louder than any tweet. You may run the government, but we run the economy. It is a brutal lesson in the hierarchy of power. The state may claim sovereignty, but capital knows no borders, and it acknowledges no master but profit. And where are the American regulators in all of this? Where is the Federal Reserve? This is the question you should be asking. For years, Jerome Powell and the Fed have assured us that the banking system is sound, that the stress tests prove these institutions can weather any storm. But did they stress test for a coordinated withdrawal of Canadian capital? Did they model what happens when our closest trading partner decides to turn off the liquidity tap? The answer clearly is no. They were asleep at the switch, lulled into complacency by the idea that friends don't wage economic war. They forgot the first rule of the market. There are no friends, only interests. The irony here is painful. The United States spent decades lecturing the rest of the world about the virtues of open markets. The IMF and the World Bank, largely controlled by U.S. interests, forced developing nations to open their banking sectors to foreign capital, telling them it was for their own good. Now the shoe is on the other foot. The U.S. is tasting the bitterness of its own medicine. It is finding out what it feels like to be a debtor nation dependent on foreign benevolence. The vulnerability that the U.S. exported to Latin America and Asia in the 1980s and 90s has come home to roost on Wall Street. This situation also exposes the utter failure of the too big to fail doctrine. After 2008, we were told that regulations were put in place to prevent another systemic collapse. We were told that banks would be safer, but look at what actually happened. The big banks just got bigger, and the foreign banks became more integrated. By allowing institutions like TD and RBC to become systemic to the U.S. economy, the regulators didn't reduce risk. They just outsourced it. They handed the keys to the U.S. economic engine to executives in Toronto who do not answer to the American voter. When you go to the ballot box, you cannot vote Mark Carney out of office. You cannot vote out the board of directors of the Royal Bank of Canada. Yet they hold the power to determine if your local small business gets a loan next week. That is the democracy deficit at the heart of financial capitalism. We need to talk about the wider consequences of this because this goes far beyond a temporary dip in the stock market or a bad quarter for regional banks. This is a signal to the entire world, a flare sent up from the bedrock of the global economy. The United States has long operated on the exorbitant privilege of the dollar. We print the world's reserve currency, which allows us to run massive deficits and borrow cheaply because the world has always assumed that American debt is the safest asset on earth. That assumption is the invisible pillar holding up the American standard of living. But if the U.S. banking system can be brought to its knees by a liquidity squeeze from Canada, that assumption is shattered. If the king of debt cannot manage its own plumbing, why should China, Japan, or Saudi Arabia keep buying our treasury bonds? If confidence in the U.S. financial system erodes, the consequences for you are catastrophic. It means higher interest rates on your mortgage, not because the Fed wants to cool inflation, but because lenders demand a risk premium to lend to a volatile country. It means a weaker dollar, which makes everything you buy at Walmart or the grocery store more expensive. We are talking about the potential end of the era where the American consumer could live beyond their means on the back of cheap foreign credit. The standard of living that many Americans take for granted is built on this financial foundation, and Mark Carney just showed us exactly how many cracks are in the concrete. This is also a major blow to the illusion of friendshoring. You have heard the politicians in Washington talk about moving supply chains away from rivals like China and toward allies like Canada and Mexico. They said this would make us secure. They sold it as a return to safety. Well, look around. Your ally is currently holding your banking system hostage. It turns out that relying on foreign capital from a friendly nation is just as dangerous as relying on it from a rival when interests diverge. There is no safe harbor in a globalized system where profit maximization is the only law. The handshake in the diplomatic photo op means nothing when the balance sheet is at risk. This exposes the naivety of the current political strategy. You cannot insulate yourself from global shocks just by changing which flag flies over the factory or the bank. As long as you are dependent on external capital, you are vulnerable. And right now, the United States is more dependent than it has been in a century. As we move to the final assessment of this crisis, we have to look at the human impact because while the titans of finance clash in the clouds, the rain falls on the rest of us. We need to talk about what this means for the teller at the bank branch that might close, a branch that has been the anchor of a main street for a generation. We need to talk about the family trying to refinance their home to pay for a child's tuition, only to find the rates have jumped overnight because of a liquidity crunch started in a foreign capital. We need to talk about the public sector employees, teachers, firefighters, police officers, whose pension funds are invested in these shaky markets. When the market corrects, their future is what evaporates. The suffering in these stories is never evenly distributed. The people who made the mess, the architects of this fragility, have golden parachutes. They have hedge funds. They have assets in Switzerland and the Caymans. The people who clean it up have pink slips. The reality we must confront is that when the titans of finance decide to go to war, the system is working exactly as it was designed for them. It is not broken. It is functioning efficiently to protect capital at the expense of labor, to protect the creditor at the expense of the debtor. As you watch the ticker tape and hear the spin from the White House or the silence from the Federal Reserve, remember this: the volatility you are feeling is the price of their arrogance. They built a system of glass and told you it was steel, and now that it is shattering, they expect you to be the one to sweep up the shards. That is the hard truth of this financial crash. It is not just about numbers on a screen. It is about the transfer of wealth and power away from you and toward the people who already have it all. And until we demand a system that prioritizes national resilience over global efficiency, we will remain vulnerable to the next shock, the next squeeze, and the next crisis. That is the lesson Mark Carney is teaching us, and it is a lesson we can no longer afford to ignore.